In this video, we will be reviewing Affirm's FY Q3 2026 earnings supplement. This document, released on May 7, 2026, contains crucial supplemental information for investors. Affirm, a leading company in the buy now, pay later (BNPL) sector, sees its earnings reports closely watched by the market. We will delve into their financial performance, analyze market trends, and discuss investment outlook related to these results. This slide presents the key highlights for the third quarter of fiscal year 2026. First, gross merchandise volume, or GMV, reached $11.6 billion, reflecting a 35% year-over-year growth. This indicates a very robust expansion. Active consumers numbered 26.8 million, showing a 22% growth rate, which suggests a steady increase in the customer base. Transactions per active consumer averaged 6.7, a 20% increase, indicating that customers are spending more per transaction. Finally, revenue stood at $1.039 billion, achieving a strong 33% growth rate. All these metrics strongly suggest that the company's overall growth momentum is strengthening and its business model is successfully scaling. This chart illustrates the trends in gross merchandise volume, GMV, and average order value, AOV. The blue bars represent GMV, showing a consistent growth from $6.3 billion in FY Q3 FY24 to an projected $11.6 billion in FY Q3 26. A notable increase to $10.1 billion occurred in FY Q2 FY25, followed by a temporary dip to $8.6 billion in Q3 25, before resuming its upward trajectory to $10.4 billion in FY Q4 25, $10.8 billion in FY Q1 26, and a projected $13.8 billion in FY Q2 26, then $11.6 billion in FY Q3 26. The yellow line indicates AOV, which starts at $293 in FY Q3 FY24 and shows a general downward trend, projected to fall to $267 in FY Q2 25 and $251 in FY Q2 26. The substantial growth in GMV while AOV declines suggests an increase in the number of transactions with a slight decrease in the value per transaction. This could indicate increasing platform adoption with a rise in smaller purchases, and a slight rebound in AOV is projected to $255 by FY Q3 FY26. The 35% growth indicated at the top likely refers to a specific growth rate at a point in time, emphasizing the overall upward trend in GMV. First, the left chart displays Affirm's direct-to-consumer gross merchandise volume, GMV, on a quarterly basis. The purple bars represent GMV through the Affirm marketplace, while the orange bars represent GMV through the Affirm card. We can observe a consistent growth trend from Q3 FY24 to Q3 FY26, with a notable increase in the proportion of GMV from Affirm card over time. The right chart illustrates the changes in Affirm card active consumers and card attach rate. The blue line indicates the number of active consumers, and the orange line shows the card attach rate. The number of active consumers is rapidly increasing from approximately 4 million in Q3 FY24 to around 12 million in Q3 FY26. Similarly, the card attach rate is rising from about 7% in Q3 FY24 to approximately 19% in Q3 FY26. A significant highlight is that in Q3 FY26, Affirm card active consumers reached 4.4 million, marking a 130% year-over-year growth, with a card attach rate of 17%. This indicates that the Affirm card is playing an increasingly vital role in the consumer's purchasing journey. Here we have two donut charts. The left one illustrates POS versus Affirm transactions for FY Q3 2026, with point-of-sale transactions making up 76% and Affirm transactions accounting for 24%. This indicates that Affirm represents a significant portion of the overall transaction volume. The chart on the right displays the composition of Affirm's GMV, gross merchandise value. Interest-bearing products constitute the largest share at 71%, showing a 33% year-over-year growth. Additionally, Pay in X, short-term 0% APR, products make up 16% with a substantial 52% growth rate, and 0% APR monthly installment payments account for 13% with a 30% growth rate. This suggests that Affirm's core business is interest-bearing installment financing, with particularly strong growth observed in its short-term, interest-free installment products. This chart displays the industry gross merchandise volume, GMV, mix for FY Q3 FY 26. The bar graph illustrates the proportion of transaction volume for each category, with the year-over-year growth rate shown on the right. The most prominent category is general merchandise, accounting for 29% of the total GMV, representing the largest share. Despite its high proportion, this category's growth rate is 12%, indicating a relatively slower pace of expansion. In contrast, travel/ticketing and fashion/beauty categories, with shares of 15% and 14% respectively, are showing robust growth rates of 29% and 24%, which are particularly noteworthy. Electronics and home/lifestyle have a 7% share each, with growth rates of 14% and an impressive 43% respectively. The substantial growth in home/lifestyle is especially striking. Equipment/auto shows a 5% share with a 19% growth rate, and sporting goods and outdoors has a 2% share with a 7% growth rate. The services category, with a 4% share, demonstrates a very high growth rate of 53%, suggesting significant potential. Lastly, the other category, despite its 17% share, recorded an overwhelming growth rate of 99%, indicating a substantial increase in transaction volume compared to the previous year. This data serves as a crucial indicator for understanding current market share and future growth potential across different categories. Let's begin by examining this chart titled Active Consumers. The blue bars represent Affirm active consumers, M, indicating the number of active consumers in millions. The yellow line shows transactions per active consumer, which is the average number of transactions per active consumer. From FY Q3 FY 24 to FY Q1 26, the number of active consumers steadily increased from 17.8 million to 24.1 million. Notably, in FY Q1 FY 26, the figure reached 24.1 million, demonstrating significant growth compared to the previous quarter. Concurrently, the average transactions per active consumer rose from 4.6 to 6.1. This signifies not just an increase in the sheer number of consumers, but also that each consumer is engaging more actively with the platform. The 24.1 million active consumers and 6.1 average transactions in FY Q1 FY 26 are particularly noteworthy figures. Furthermore, the trend line beyond FY Q1 FY 26 projects a 22% consumer growth rate and a 20% growth rate in transactions per active consumer. This data suggests that the company's user base is expanding robustly, and engagement from existing users is also increasing. This is expected to have a positive impact on future revenue growth and profitability. This chart displays the quarterly total transactions from FY Q3 FY 24 to FY Q3 26. The blue bars represent repeat customer transactions, while the yellow bars indicate first-time customer transactions. A key observation is the consistent upward trend in total transaction volume. Notably, the highest volume was recorded in FY Q2 FY 25 at 54.9 million, primarily driven by strong repeat customer growth. Although there was a slight adjustment to 41.4 million in FY Q1 FY 26 and 45.3 million in FY Q3 26, the overall growth trajectory remains positive. Furthermore, the highlighted metrics of 45% growth and 96% repeat customers emphasize that the business's core strength lies in acquiring and retaining repeat customers. This data serves as a positive indicator of the company's ability to achieve sustained transaction volume growth based on customer loyalty. This bar chart illustrates the number of active merchants, with the blue portion representing merchants with a trailing 12-month (TTM) gross merchandise volume (GMV) greater than $1,000, and the orange portion representing those with GMV less than or equal to $1,000. From FYQ3 FY24 to FYQ3 26, the total number of active merchants shows a consistent upward trend. Notably, the number of merchants with TTM GMV exceeding $1,000 is visibly growing each quarter, as seen in the blue bars. For instance, it increased from 117K in FYQ3 FY24 to 210K in FYQ3 26. Indicating that the expansion of high-value transaction merchants is driving this company's growth. Overall, a 44% growth rate has been recorded, with merchants having over $1,000 in TTM GMV specifically showing a 41% growth, which suggests qualitative business expansion and the capability to deliver high-value services. This slide illustrates the year-over-year growth trends for the company's key operating metrics. Looking at the gross merchandise volume growth chart on the top left, it began at 36%, saw a slight dip to 31% in FYQ4 24, recovered to 36% by FYQ3 25, peaked at 43% in FYQ1 26, and then gradually declined to close at 35% in FYQ3 26. This indicates a potential slowdown in top-line growth but still signifies robust growth. The active consumers growth chart on the top right shows a steady increase from 18% to 24% by FYQ4 25, followed by a slight decrease to 23% in FYQ2 26, and ending at 22%. This signifies continuous expansion of the user base, though with some fluctuation in the growth rate. The total transactions growth chart at the bottom left started at 42%, rose to 45% in FYQ1 25 and 46% in FYQ2 25, peaked at 52% in both FYQ3 25 and Q4 25, then fell to 44% in FYQ1 26 before rebounding to 45% in FYQ3 26. This suggests transaction activity expanded, experienced a correction period, and is now showing signs of recovery. Finally, the total active merchants growth chart at the bottom right, starting at 19%, steadily increased to 21% in FYQ2 25, 23% in FYQ3 25, and 24% in FYQ4 25, before a sharp jump to 30% in FYQ1 26, and significantly accelerating to 42% in FYQ2 26 and 44% in FYQ3 26. This demonstrates explosive growth in the merchant ecosystem, indicating enhanced platform competitiveness and substantial new merchant acquisition. Overall, while the company's top-line growth may see some moderation, the consistent and, at times, explosive growth in active users, merchants, and transaction volume can be interpreted as positive signs. This chart illustrates the company's quarterly revenue trend. As you can see, the purple bars represent revenue in millions of dollars, and the orange line indicates the percentage of revenue relative to gross merchandise volume, GMV. Revenue began at $576 million in FYQ3 FY24 and steadily increased to $1,123 million by FYQ1 26. Notably, revenue has consistently exceeded $1,000 million since FYQ3 FY25, demonstrating a positive growth trajectory. The percentage of revenue to GMV has fluctuated between the mid-8% and early 9% range, suggesting the company is effectively converting GMV growth into revenue. For the most recent quarter, FYQ3 FY26, revenue was $1,039 million, a slight decrease from the previous quarter. However, the percentage of revenue to GMV rose to 9%, indicating continued robust profitability. This trend highlights the company's strong potential for sustained growth. This chart illustrates merchant fee rates measured by gross merchandise volume, GMV, across various product types. Observing the core 0% long line, which represents the highest fee rate, it begins at approximately 12.5% in FY Q3 24, reaches its peak at around 12.75% in FY Q2 25, and then gradually declines, stabilizing at approximately 11.5% by FY Q3 26. The core 0% short line starts at about 5% in FY Q3 24, rises to around 5.5% by FY Q1 25, and subsequently shows a slight downward trend, decreasing to about 5.25% by FY Q3 26. The core IB and Pay in X lines, depicted in purple and dark blue respectively, maintain stable fee rates with minimal fluctuation, staying around the 2.5% mark. Specifically, core IB consistently remains in the low 2% range from FY Q3 24 through FY Q3 26, while Pay in X fluctuates between the late 2% and early 3% range, indicating relatively lower fee rates. The declining trend in the core 0% long fee rate is particularly noteworthy and could be attributed to factors such as increased GMV for this product or heightened competition. In contrast, core 0% short exhibits a slight decrease, while core IB and Pay in X demonstrate remarkable stability in their fee rates. These fee rate trends have a direct impact on the company's profitability, making it crucial for investors to closely monitor these changes alongside the GMV growth for each respective product. The left graph illustrates the interest income composition. The blue bars represent consumer and other interest income, $M, while the orange bars denote the amortization of discount, $M. We observe a consistent upward trend in total interest income from Q3 FY24 to Q3 FY26, reaching $532 million in Q3 FY26. The majority of this income stems from consumer and other interest, with the amortization of discount being a smaller but gradually increasing component. However, the light purple line, indicating amortization of discount as percent of total interest income, remains stable between 15% and 17%, suggesting that the increase in discount amortization is a natural consequence of the overall growth in interest income. This trend signifies the company's robust and stable profitability. The right graph displays the composition of average loans held for investment, LHFI. The blue bars show the average interest-bearing LHFI balance, $M, and the orange bars represent the average 0% APR LHFI balance, $M. The total average LHFI balance has significantly increased from $5.35 billion in Q3 FY24 to $8.673 billion in Q3 FY26. While the proportion of 0% APR LHFI has slightly risen from 27% in Q3 FY24 to 29% in Q3 FY26, the interest-bearing LHFI still constitutes a larger portion. This indicates that the company is successfully expanding its loan portfolio that generates interest income. The gradual increase in 0% APR loans can be interpreted as a response to changing market conditions, through which the company is pursuing strategic growth. Overall, this data confirms that the company's asset size and its ability to generate revenue are growing in tandem. The left chart illustrates total transaction costs, while the right chart shows transaction costs excluding provisions. In both charts, the blue bars represent costs in millions of dollars, and the orange line indicates the percentage of GMV. Total transaction costs started at $345 million in FYQ3 24, peaked at $581 million in FYQ2 26, and then slightly decreased to $541 million in FYQ3 26. Notably, the percentage of transaction costs relative to GMV began at 5.5% in FYQ3 24 and has gradually declined, stabilizing around 4.4% from FYQ2 25 onwards. This suggests improving cost efficiency as transaction volumes increase. The right chart, transaction costs excluding provisions, rose from $223 million in FYQ3 FY24 to $366 million in FYQ2 26 before declining to $344 million in FYQ3 26. The percentage of GMV in this category shows a more stable trend, starting at 3.5% and decreasing to 2.7%, indicating that provisions have been a variable component of total transaction costs. Overall, these figures suggest that the company's cost management efforts are contributing to maintaining a stable cost ratio relative to GMV. The left chart illustrates revenue less transaction costs. It starts at $231 million in Q3 FY24 and shows a consistent upward trend, reaching $695 million by Q3 FY26. With a significant surge from Q2 FY25 to Q2 FY26 peaking at $757 million. The year-over-year growth rate stands at a robust 41%. Concurrently, the percentage of GMV, represented by the yellow line, remained stable, fluctuating between 3.7% and 4.3%. The right chart displays revenue less transaction costs ex provision. This metric also exhibits a steep upward trajectory, increasing from $353 million in Q3 FY24 to $757 million in Q2 FY26, before a slight decrease to $695 million in Q3 FY26. Despite this, it maintains a high year-over-year growth rate of 39%. The percentage of GMV ranges from 5.5% to 6.0%, with a notable dip to 5.5% in Q2 FY26 followed by a rebound to 6% in Q3 FY26. Both metrics demonstrate positive growth trends, and the increase in the ex-provision metric particularly suggests ongoing improvements in the profitability of the core business. These three charts illustrate the operating expenses for technology and data analytics, sales and marketing, and general and administrative costs, respectively. Technology and data analytics expenses show a steady increase from $125 billion in FYQ3 FY24 to $192 billion in FYQ3 26. Notably, GAAP figures saw significant jumps from $71 billion in FYQ2 FY25 to $75 billion in FYQ3 25, and from $79 billion in FYQ1 26 to $87 billion in FYQ2 26. In contrast, sales and marketing expenses have consistently declined, from $133 billion in FYQ3 FY24 to $73 billion in FYQ3 26, with the decline accelerating particularly after $74 billion in FYQ3 25. General and administrative expenses increased from $129 billion in FYQ3 FY24 to $145 billion in FYQ3 26. Though the rate of increase shows a tendency to slow down compared to previous quarters. Examining the percentage of revenue for each category, technology and data analytics expenses as a percentage of revenue slightly decreased from 19% in FYQ3 FY24 to 18% in FYQ3 26. Sales and marketing expenses as a percentage of revenue significantly dropped from 23% to 7%. And general and administrative expenses as a percentage of revenue have gradually decreased from 22% to 14%. These changes in cost structure indicate the company's growth strategy and efforts towards efficiency improvements, with the effective management of sales and marketing expenses being a particularly positive signal. This slide compares GAAP operating income/loss and adjusted operating income/loss. Looking at the GAAP operating income/loss chart on the left, it began with a loss of $161 million in FYQ3 FY24, widened to $73 million in FYQ4 24, and then expanded to $133 million in FYQ1 25, before turning positive from FYQ2 25 onwards, reaching a profit of $88 million in FYQ3 26. showing an overall improvement. The operating margin also increased from -28%, gradually rising and maintaining between 7% and 10% after FY Q2 FY25. The chart on the right shows the adjusted operating income/loss, which excludes certain items such as depreciation, amortization, and stock-based compensation expenses. This adjusted operating income/loss started at $130 million in FY Q3 FY24, steadily increased to $150 million in FY Q4 24 and $174 million in FY Q1 25, peaking at $337 million in FY Q2 26 before a slight decrease to $281 million in FY Q3 26. The adjusted operating margin started at 19%, maintained in the mid-20s, and rose to 30% in FY Q2 FY26 before a slight dip to 27% in FY Q3 26. Comparing these two charts, we can see that while there was an initial loss period on a GAAP basis, the company consistently recorded profits and grew on an adjusted basis. More recently, even on a GAAP basis, the company has turned profitable, continuing a positive trend. This trajectory suggests that the company's core business is growing robustly, which can be interpreted as a positive signal for investors. This chart illustrates the reconciliation of net income to adjusted operating income, quarter over quarter, and for the 12-month period. Looking at the waterfall chart for the quarter ending March 31, 2026, we start with a net income of $103, add back other expenses of $19, account for a tax benefit of $4, and after other adjustments, arrive at an adjusted operating income of $281. For the 12 months ending March 31, 2026, the adjusted operating income stands at $1,119, starting from a net income of $382 and incorporating adjustments for other expenses, taxes, and operating costs. Examining the table, net income increased from $69 on June 30, 2025, to $103 on March 31, 2026. However, adjusted operating income shows a more moderate increase, from $237 on June 30, 2025, to $281 on March 31, 2026, for the respective quarters. Key components driving the increase in adjusted operating income include depreciation and amortization, stock-based compensation, and enterprise warrant and share-based expenses. These adjustments provide a clearer view of the company's core operational performance, excluding certain non-cash or non-recurring items. This chart displays the platform portfolio and funding mix from Q3 2024 to Q3 2026. With stacked bars representing the proportion of different funding methods for each quarter. The bottom blue segment signifies on-balance sheet, non-securitized, assets, the light purple represents on-balance sheet, securitized, assets, and the middle green indicates off-balance sheet, non-securitized, assets. The top dark green segment denotes off-balance sheet, securitized, assets, and the sum of these four components constitutes the total platform portfolio size. For instance, in Q3 2024, the total portfolio is $10.4 billion, with $4.4 billion in on-balance sheet non-securitized assets, $3.4 billion in on-balance sheet securitized assets, $0.4 billion in off-balance sheet non-securitized assets, and $2.1 billion in off-balance sheet securitized assets. The yellow line indicates the equity capital REQ% platform, which generally remains stable or shows slight fluctuations over time. Notably, the total platform portfolio size shows a consistent upward trend, growing from $10.4 billion in Q3 2024 to $18.4 billion in Q3 2026. The proportion of securitized off-balance sheet assets is gradually increasing, suggesting an expansion in the company's strategy of funding through asset securitization. The absolute dollar amounts for each asset component are also generally increasing, reflecting portfolio growth driven by business expansion. This structure serves as a crucial indicator for understanding the company's financial health and growth strategy. This bar chart illustrates the weighted average remaining term in months, as of quarter-end date, for the total platform portfolio and the on-balance sheet platform portfolio, spanning from FY Q3 FY24 to FY Q3-26. The blue bars represent the total platform portfolio, while the light green bars denote the on-balance sheet platform portfolio. Across all periods shown, both portfolios exhibit a remarkably stable trend with a weighted average remaining term hovering between 10 and 11 months. This indicates that the maturity structure within the portfolio is consistently managed, maintaining a uniform maturity profile without any significant shifts towards predominantly short-term or long-term loans. Such stability can be interpreted as a positive sign from a financial health perspective. This chart illustrates the company's funding capacity. The blue bars represent the funding capacity in billions of dollars, showing a consistent upward trend from $15.6 billion in fiscal Q3 FY24 to $28.2 billion in fiscal Q3 26. Notably, the growth in funding capacity accelerates from fiscal Q1 FY25 onwards. The orange line indicates the total platform portfolio's percentage of the funding capacity. This percentage started at 66% in fiscal Q3 FY24, rose to 70% in fiscal Q1 25, and then gradually decreased to 65% by fiscal Q3 26. This suggests that while the company's funding capacity is steadily increasing, the ratio of the portfolio to the funding capacity may moderate slightly. Overall, the continuous growth in funding capacity can be interpreted as a positive sign for business expansion and enhanced financial stability. However, it is important to closely monitor the fluctuations in the funding ratio and analyze the balance between funding strategies and portfolio growth. This chart illustrates the monthly delinquency rate, specifically DQ30+, which represents the percentage of active balances that are 30+ days past due, broken down by various fiscal years. As observed, the delinquency rates from FY 2026 down to FY 2022 are hovering within a relatively stable range between 2% and 3%, with a general upward trend throughout most of the depicted period. Notably, FY 2024, orange line, FY 2025, dark green line, and FY 2026, purple line, show similar patterns around the 2.5% mark, suggesting that these delinquency rates are expected to remain relatively consistent over the coming years. In contrast, FY 2020, light blue line, and FY 2021, gray line, exhibit lower delinquency rates, with FY 2020 showing a consistent decline below 2%. This indicates that historical performance has been stronger than the projected delinquency rates. Therefore, investors should carefully monitor these delinquency trends when assessing the health of new loan portfolios. This chart illustrates the monthly delinquency performance, specifically the percentage of active balances that are 30+ days past due. Each colored line represents a different fiscal year, with the blue line for FY 2020 and the gray line for FY 2021 showing the initial data range. Observing the trends from FY 2022 to FY 2026, we see that delinquencies in FY 2022 and FY 2023 are generally higher compared to FY 2020 and FY 2021. Notably, the gray line for FY 2022 starts around 2.5% and rises above 3%, with the light green line for FY 2023 showing a similar pattern. The orange line for FY 2024 and the green line for FY 2025 maintain a relatively stable trend between 2.5% and 3% before showing a recent downtrend, while the purple line for FY 2026 currently records the lowest delinquency rates. Overall, there appears to be a seasonal pattern where delinquency rates tend to rise at the beginning of the year and moderate somewhat towards the end. This is a crucial indicator for assessing the health of the loan portfolio, and this trend could change depending on future interest rate fluctuations, economic conditions, and changes in consumer repayment capacity. This slide presents the monthly installment loan delinquency rates. First, looking at the delinquency rate for 30-plus days, it generally showed an improving trend, falling from 2.5% as of September 30, 2020, to 0.8% by March 31, 2021. Notably, the delinquency rates for FI 2021 and FI 2022 remained relatively low, but showed an increase again in FI 2023, with the projection for FI 2026 being 2.8%. Next, the 60-plus days delinquency rate significantly decreased from 1.4% on September 30, 2020, to 0.4% by March 31, 2021, and has since fluctuated between 0.9% and 1.6% after FI 2022, with a projection of 1.4% for FI 2026. Finally, the 90-plus days delinquency rate fell from 0.6% on September 30, 2020, to 0.2% by March 31, 2021, and has since remained between 0.4% and 0.8%, with a projection of 0.7% for FI 2026. These delinquency rate trends suggest fluctuations in consumers' repayment ability due to changes in economic conditions, and the rising trend in delinquency rates after FI 2023 warrants careful observation. This table presents the monthly installment loan delinquency rates for Peloton, broken down by quarter. Looking first at the 30-plus days delinquent category, we see a decrease from 3.2% in FI 2020 to 1.4% in FI 2021, followed by an increase to 2.1% in FI 2022 and 3.2% in FI 2023. Subsequently, rates are projected to stabilize around 2.5% from FI 2024 onwards. The 60-plus days delinquent category also shows a pattern of initial decrease from 1.8% in FI 2020 to 0.8% in FI 2021, then an increase to 1.9% in FI 2023 before declining again, with an expected rate of 1.4% in FI 2026. Lastly, 90-plus days delinquent rates remain generally low, with a slight increase from 0.4% in FI 2021 to 0.9% in FI 2023, after which they are expected to stabilize. This data reflects the overall health of Peloton's loan portfolio, suggesting a potential for gradual improvement in delinquency rates from 2023 onwards. This chart displays the trend of 30-plus day delinquency rates for various consumer lenders. Based on data from late December 2023 to late March 2026, it compares the delinquency rates of different issuers, the DV01 Consumer Unsecured Index, and Affirm. Issuer B, represented by the blue line, starts in the low 6% range and fluctuates to the high 5% range, generally recording the highest delinquency rate. Issuer A, shown in green, and Issuer C, represented by the gray dashed line, move between the high 4% and low 5% range, showing a relatively stable trend. Notably, Issuer A and Issuer C show a slight increase in delinquency rates from mid-2025 onwards. Affirm's delinquency rate, depicted by the black line, begins in the 2% range and shows a gradual increase to the low 3% range by the end of 2025. This indicates that while Affirm maintains a relatively lower delinquency rate compared to other institutions, there is a possibility of a slight increase in delinquency over time. The table on the right shows that as of late March 2026, the percentage of non-prime receivables is 41% for Issuer B, 27% for Issuer A and Issuer C respectively, while Affirm has the highest proportion at 43%. A higher percentage of non-prime receivables means the institution has extended a larger volume of loans to customers with lower creditworthiness, which can potentially be linked to a higher delinquency risk. Therefore, considering Affirm's gradually increasing delinquency trend alongside its high non-prime receivable ratio, its future delinquency management strategy will be crucial. This table presents the loan balance and net charge-offs by loan origination fiscal year as of March 31, 2026. Firstly, looking at loans held for investment and loans held for sale, we observe a substantial loan balance of $7.53 billion as of the 2026 fiscal year. This figure represents a significant increase compared to $866.13 million in the prior year, 2025, and shows a dramatic growth from $71.02 million in 2024. The balance tends to decrease as we look further back into the loan origination years. Next, examining current period charge-offs, we see the highest amount of $98.43 million in 2026, which can be interpreted as a natural consequence of the increased loan volume. However, charge-offs were very low in 2023 at $0.2 million and in 2022 at $0.05 million, suggesting a smaller volume of loans originated or less charge-off activity in those years. Current period recoveries show an inverse trend. In 2026, recoveries were $3.77 million, a decrease from $11.00 million in 2025. Interestingly, recoveries tend to increase for older loan origination years, specifically $4.39 million in 2024, $1.65 million in 2023, and $0.67 million in 2022. Finally, current period net charge-offs, calculated as charge-offs minus recoveries, indicates a net charge-off of $94.66 million in 2026. This is an increase from $67.73 million in 2025 and a considerably larger figure compared to $2.11 million in 2024, $1.45 million in 2023, and $0.62 million in 2022. Overall, it appears that the significant increase in loan volume in 2026 has also led to an increase in net charge-offs, which could be a crucial indicator for the financial institution's asset quality management going forward. Let's focus on the trend presented in this chart. The blue bars represent the allowance for losses, which is the amount set aside to cover potential loan defaults. This figure has steadily increased from $289 million in FYQ3 24 to $512 million in FYQ3 26, indicating that the company is proactively building its reserves in anticipation of future losses, likely due to portfolio growth. The orange line illustrates the allowance percent of loans held for investment. This ratio started at 5.3% in FYQ3 24, saw a slight increase to 5.4% in FYQ1 25 and 5.7% in FYQ3 25, then dipped to 5.4% in FYQ2 26, before rising to 6% by FYQ3 26. While the absolute allowance for losses is growing, the ratio of this allowance to the total loans held for investment shows some volatility, with a recent uptick. These metrics are crucial for assessing the company's credit risk management and the health of its loan portfolio. Let's first examine the quarterly changes in the allowance for credit losses. The allowance for credit losses stood at $478 at the end of December 2025 and increased to $512 by the end of March 2026. This is because while the provision for losses was $192 during the same period, net charge-offs decreased to $158. Next, let's look at the change in the allowance for credit losses over the last 12 months. The allowance for credit losses was $375 at the end of March 2025, and it increased to $512 by the end of March 2026. During this period, the provision for losses was $703, and net charge-offs were recorded at $566. The table details the beginning allowance, provision for loan losses, net charge-offs, and ending allowance for each quarter. Notably, as of March 31, 2026, the loans held for investment amounted to $8,573, and the allowance as a percentage of loans held for investment was 6%. This figure indicates the company's preparedness for potential loan losses, representing a 0.6 percentage point increase from the previous quarter. This slide details the key assumptions incorporated into Affirm's outlook. Firstly, concerning the product mix, the share of 0% APR GMV inclusive of Pay and X products in FQ4 26 is expected to remain stable on a year-over-year basis. These 0% APR products generally exhibit a lower RLTC as a percentage of GMV compared to equivalent interest-bearing products. Secondly, in terms of enterprise partnerships, an enterprise merchant has expressed an intent to switch its pay later volumes to its own wallet solution, with this transition substantially completed during FQ1 FY26. Thirdly, for the interest rate environment, based on the forward curve embedded within the outlook, short-term benchmark interest rates are expected to remain stable during FQ4 FY26 compared to FQ3 FY26. Fourthly, regarding funding, the equity capital required (ECR) as a percent of total platform portfolio (ECR ratio) is expected to remain below 5%. Fifthly, for product and go-to-market initiatives, our outlook includes the expected financial impact of our expansion outside of North America, which is not expected to be a material growth contributor during FY26. Lastly, concerning the deferred tax asset valuation allowance, if our earnings trajectory continues, the company expects that there may be sufficient positive evidence to support the release of a significant portion of the U.S. deferred tax valuation allowance by the end of fiscal year 2026. The screen presents a table summarizing Affirm's financial outlook for the fourth quarter and the full fiscal year of 2026. Firstly, for gross merchandise volume, GMV, the outlook for Q4 fiscal 2026 is between $13.15 billion and $13.45 billion, with the full fiscal year projected to reach between $49.265 billion and $49.565 billion. Revenue is expected to be between $1.080 billion and $1.110 billion in the fourth quarter, and between $4.175 billion and $4.205 billion for the full year. Transaction costs are anticipated to range from $545 million to $560 million for Q4, and $2.144 billion to $2.159 billion annually. Consequently, revenue less transaction costs is projected to be between $535 million and $550 million in the fourth quarter, and between $2.031 billion and $2.046 billion for the full year. The operating margin is forecasted to be between 9.5% and 11.5% in Q4, and between 8.9% and 9.4% for the full fiscal year. The adjusted operating margin shows a more optimistic outlook, projected between 27.5% and 29.5% for Q4, and 28.2% to 28.8% for the full year, indicating a significant expected improvement in margins in the fourth quarter. Finally, the weighted average basic shares outstanding are estimated at 341 million for Q4 and 336 million for the full year, while the weighted average diluted shares outstanding are projected at 352 million for Q4 and 349 million for the full year, suggesting a slight increase in outstanding shares in the fourth quarter compared to the full-year outlook. These figures reflect expectations for Affirm's future business growth and profitability improvements.